For the last decade, the startup ecosystem has been obsessed with hypergrowth. Billions of dollars chase the next consumer app while ignoring the foundation of the economy. The real bottleneck isn't a lack of disruptive ideas, it is a lack of structured execution for everyday, standard businesses. Look at India's MSME sector. These micro, small, and medium enterprises contribute nearly 30% to the national GDP and account for over 200 million jobs. Yet, the vast majority of these ventures fail before they even officially launch. The government recognizes this gap. This is the rollout of the National Startup Action Plan. State-level initiatives and heavy subsidies are actively trying to formalize this space. The ambition is there, and the top-level support is real. We see this directly extending to the MSME layer through programs like Udami Bharat. The push for self-reliance means there is serious structural backing and available capital for small and medium enterprises. But institutional investors don't write checks based on government programs. They back execution. Capital flows towards proof of sales, tight gross margins, and supply chain control. It rarely follows a pitch deck full of ambition without a strict operational plan. This creates a trap for first-time founders. They start with a vague idea, get lost in Google research, try to navigate confusing subsidy portals, and end up submitting weak project reports. The inevitable result is bank rejection and depleted savings. The high failure rate in the sector is the result of a multi-stage journey, where information is scattered and access to capital is siloed. When the path from idea to launch is this fragmented, the barrier to entry remains insurmountable for most founders, regardless of their merit. The arbitrage here is what we call the boring business. These are operations built around essential physical demand: raw material trading, industrial consumables, and B2B distribution. Look at this physical workshop. Asset-backed operations like manufacturing and industrial processing require heavy machinery and dense layouts. Because they are tied to tangible assets and essential supply chains, they are highly resilient to economic hype cycles. You can see the friction directly in scenes like this. The manual sorting of massive physical inventories, like rusted pipes and scrap metal, represents raw material aggregation. These circular economy ventures are unglamorous, but they generate stable cash flow. The target founder for these operations is rarely a traditional tech developer. They are serious, first-time entrepreneurs, perhaps a couple pooling their savings, or a family business successor with strong community ties and modest initial capital. The traditional path for these founders is a series of confusing research tasks and capital stress. But if you can digitize and stage this progression, matching founder fit to a specific funding route and a clear launch plan, you remove the guesswork entirely. Consolidating these fragmented analog trades into a digitized execution pipeline builds a new class of high-yield, asset-backed opportunities for institutional investors. This is where Rabbi comes in. It is a multi-agent AI architecture designed to scale venture intelligence and lower the cost of building a business. At the center is the orchestrator node. It filters a funnel of business ideas for cash flow stability. Surrounding it are specialized agents. The scout scans supply chains, the economist tracks inflation, and the funding expert queries lenders. They feed data back simultaneously. The process begins with the initialization protocol. A founder inputs their available capital, location, and risk tolerance. Toggling a specific constraint, like the women-led advantage, instantly routes the entire swarm to hunt for MSME schemes reserved specifically for female entrepreneurs. To maintain strict factual accuracy, these agents rely on a local vector memory database and live search grounding. When they output a project plan, they are pulling real-time market prices, specific vendor names, and active government notifications. By automating the initial research and project modeling, the platform removes the weeks of manual work and high advisory fees that typically stall a small business before it starts. The founder moves from a profile to a vetted, bank-ready plan in a fraction of the traditional time. We call this thesis ironing the supply chain. Instead of inventing new consumer behaviors, the system actively hunts for under-digitized friction nodes in existing B2B supply chains, ensuring immediate product-market fit. You see this friction in primary packaging. This mechanized food line requires exact inputs and reliable B2B offtake, but local supply networks are often inefficient. Once an opportunity is validated, this interface generates the asset vault. It structures the founder's plan across 4 pillars: specific B2B customer accounts, applicable government schemes, precise NBFC loan recommendations, and the required logistics. It builds a blended capital stack rather than relying on a single bank loan. This structured data flows directly into the investor marketplace dashboard. Institutional investors get pre-vetted diligence on microventures. They see the exact capital requirements, matched subsidies, and verified supplier links, completely stripping away the usual noise. For providing end-to-end incubation, the platform takes a 3 to 5% micro-equity stake. It serves as a central hub connecting to dozens of operations. This equity range is low enough for founders to accept, but provides upside as the businesses yield cash. It takes the economics of a venture studio and applies them directly to traditional MSMEs. The result is hundreds of small, profitable trades aggregating into one diversified, high-yield portfolio. Current solutions in this space are fragmented. You have isolated loan portals, local chartered accountants, and basic government advisory centers. Owning the end-to-end lifecycle, from initial idea generation to physical execution, is a distinct competitive advantage. This creates a compounding network moat. Every time a founder successfully launches a business, their real-world supplier data, approval rates, and capital pathways feed directly back into the platform's collective intelligence. The go-to-market strategy avoids burning capital on expensive direct-to-consumer advertising. Instead, it relies on institutional partnerships with existing MSME associations and trusted local CA networks to acquire motivated founders. The immediate unit economics are designed for scale. Free tier users are supported by optimized, low-cost AI models, while premium founders pay distinct platform fees for advanced project reports and loan readiness packages. This chart illustrates the dual-engine financial projection. The steady bar graph represents baseline operational survival through SaaS and platform fees. The curving line is the compounding long-term value of the aggregated equity portfolio. The platform sustains its own operations through digital revenue. This gives the equity portfolio the exact time it needs to mature, stabilize, and eventually drive the return multiple for investors. To achieve this, Rabbi is raising an initial angel round of 1 to 3 crore rupees. This capital is strictly required to build out the MVP multi-agent architecture and launch the first controlled incubation cohorts. This allocation breaks down exactly where the funds go. 30% is dedicated to the core tech and AI engine, 20% to founder cohort operations, with the remainder securing the investor marketplace and complex legal structuring. We are funding validation, not vanity growth. The 24-month roadmap moves the system from a pure software tool to a venture-building ecosystem. Within 2 years, the platform will expand to manage sector-specific special-purpose vehicles, pooling investor capital directly into validated MSME batches. We recognize the execution and regulatory risks. Securing a minority equity stake across hundreds of micro-enterprises requires precise legal architecture. This is protected through strict incubation agreements and milestone-gated support. That is why the founding team's composition extends far beyond software engineering. Deep operational expertise in physical supply chains, B2B logistics, and MSME debt finance is exactly as critical as the AI architecture. In a market often obsessed with finding the next unstable consumer tech trend, we are betting on physical realities. Durability, positive cash flow, and disciplined execution are the actual scarce resources in today's economy. Rabbi provides the structural infrastructure required to standardize the production of profitable, asset-backed enterprises.